Special orders. Hello all. Let's take a look at a special order problem solver. The Martin Company produces 50,000 units of batting helmets each year. The schedule shows that the cost per unit for direct materials is $35. Direct labor is $8. Variable manufacturing overhead is $2. Fixed manufacturing overhead is $20. Variable selling, general, and administrative expenses are $3, and fixed SG&A is $7. The normal selling price is $75 per helmet. Martin Company has received a large order for 3,000 helmets from an overseas customer asking for a discounted price of $65 per helmet. The company has ample idle capacity to accommodate the order, and management has determined that the order would have no effect on normal sales. While fixed costs remain unchanged, the variable SG&A would decrease by 50 cents per unit. This is an example of a special order. A special order is a one-time order that is not considered part of the company's normal ongoing business. Like other decisions, we will look at the facts and the data presented and evaluate whether to accept the special order or to pass on it. A financial advantage will occur if the improvement in the contribution margin exceeds any additional fixed costs. In these cases, we will say yes to the deal. If the change in the contribution margin is negative, or if it's less than additional fixed costs, the result will be a financial disadvantage, a decrease in profitability, and we will say no to the deal. When analyzing a special order, only the incremental benefits and costs are relevant. Costs that already exist and are not going to change are not relevant. The incremental benefits are the additional sales revenue generated, while the incremental costs include only variable cost per unit because this problem states that fixed costs will remain unchanged. Since the existing fixed manufacturing and SG&A costs would not be affected by the order, they are not relevant. This is a case when fixed costs are unavoidable. To analyze this problem, we prepare a schedule that shows the per unit information as well as the total amounts. Our first part of the analysis involves the incremental benefit. The incremental benefit is the additional revenue generated. We multiply the 3,000 helmets by the selling price of $65 to get $195,000 of additional sales revenue. Next, we look at the incremental cost. To get the incremental cost, we sum the direct material at $35, direct labor at $8, variable manufacturing overhead at $2, and variable SG&A at $3 to determine the cost per unit on our normal sales. Adding those together gives us a total of $48. Because the special order will reduce our variable SG&A by 50 cents, the variable cost per helmet for the special order will be $48 minus the 50 cents, or $47.50. Multiplying the $47.50 by 3,000 helmets gives us a total variable cost of $142,500. We can now determine the contribution margin for the special order by subtracting the total variable cost per unit of $47.50 from the discounted selling price of $65. The contribution margin per unit is $17.50. Multiplying the 3,000 helmets ordered by the $17.50 gives us an improvement in profitability or financial advantage of $52,500. We will get the same $52,500 result by subtracting total variable expenses of $142,500 from sales revenue of $195,000. Since there is a financial advantage, we would accept the order. Now let's look at a different scenario. Let's assume that our company is operating at capacity. Let's also assume that we're inclined to say yes to the deal. At this point, our analysis looks at the opportunity cost for the transaction. Remember that opportunity cost is the cost of the foregone alternative resulting from the pursuit of an alternative course of action. For this case, since we're operating at full capacity, accepting the special order means foregoing the contribution margin to be earned from sales to our normal customers. Calculating the opportunity cost requires that we compare the contribution margin per helmet from normal sales to that of the special order. The contribution margin per helmet on normal sales is the selling price per unit of $75 minus the variable cost per unit of $48 or $27 per helmet. The opportunity cost then would be $27 per helmet times 3,000 helmets, or $81,000. As an opportunity cost, the $81,000 give up must be considered, and as such is subtracted from the contribution margin produced by the special order of $52,500, calculated by multiplying 3,000 units by the contribution margin per helmet of $17.50. When we subtract the $81,000 in opportunity cost from the $52,500 for the special order, we arrive at a $28,500 financial disadvantage. At full capacity, we would say no to the deal. A final scenario would have idle capacity, but not enough to meet the 3,000 units for the special order. In our example, to accommodate the 3,000 helmets needed would require that we cut back 1,000 helmets on normal production. Doing so and preserving our financial advantage requires that we renegotiate the special order price to cover the lost contribution margin plus the additional variable cost for the special order. The lost contribution margin on the cutback of 1,000 helmets on normal sales totals $27,000, or $27 contribution margin per unit times 1,000 units. The additional variable cost for the special order equals total variable cost of $47.50 times 3,000 units, or $142,500. Adding the $27,000 and the $142,500 gives us a total cost of $169,500. We will divide the $169,500 by the 3,000 helmets to get a minimum acceptable price on the special order of $56.50. At this price, there will be no give up of earnings. That's it for special orders. Thanks for watching the video. Good luck.